Good morning class, how are you all? Today we are going to start the next part of our chapter Partnership Fundamentals is Interest on Partners Capital. So class, this is one of the most important part in the chapter, and here you need to understand the concept behind the calculation of interest on partners capital. See class, the concept is not very vast, but you have to understand the small minute points so that you can easily get into this and easily calculate the interest on partners capital. Now the thing is that why do we need to calculate interest on partners capital? Okay, so class, interest on capital, first of all we need to understand this point. Interest on capital is the amount paid or payable on the additional capital to the partner. You can also say that interest on capital is an appropriation of profit. That is, if a firm has earned profit, it will have a credit balance in the profit and loss appropriation account. So, if you have to take a part from profit and put it in partner's capital account, you will have to debit, that is, reduce profit and loss appropriation account and credit partner's capital account. It can be done directly or through interest on capital account. So class, you can clearly state that interest on capital is an expense to the firm and is debited to the profit and loss appropriation account. Interest is payable to the partners and hence the partners capital account is credited with the amount of interest. In case of loss, no interest will be allowed on capital. Class, you have to remember this thing that if there would be loss, how could a company or the partnership firm would be able to allow interest on capital? So it would utmost impossible for the firm to do so. Now class, we are moving toward the next part, that is interest on partner capital. Here the meaning has been provided. See, it is written that interest on capital is allowed to partners if it is provided in partnership deed or agreement. Just listen carefully. Interest on capital is allowed only when it is provided in partnership deed or agreement. Interest on capital is justified when the partners contribute an equal amount of capital but share profits equally. This is the most important point. So interest on capital is calculated at the given rate with reference to time period. Now class, we have to understand the next point, and the point is interest on capital. Now the thing is that we have to understand this point. What is interest on capital? So interest on capital equal to amount of capital into rate of interest, that is at what rate of interest is provided in the capital into time, that is for how much period the amount or the interest has been provided. Now if there is no additional capital introduced during the year, class, this point is important. If there is no additional capital introduced during the year, the interest on capital will be calculated on the opening balance of capital account. Whatever will be the opening balance, on that opening balance only, that is of the capital account, interest will be provided on that amount only. If capital is not given, class, listen carefully. If the opening capital is not given, then first of all it must be calculated. So what is the manner of calculation of capital? So class, here I have provided the basic format. Basic format means what? This format is applicable everywhere where you want to apply. See, this is the format. Here it's written statement showing calculation of opening capital. So class, what happens? When you will prepare your capital account, you will find closing capital or opening capital. So if you are having the opening capital, then we don't have to make any kind of calculation. Then if the closing capital is provided, then we have to find out the opening capital. So for finding out the opening capital, first of all we have to add the certain amounts in closing capital. What we have to add? We have to add the drawing made by partner. Now class, listen carefully. Why we are adding the drawing made by the partner? Because if a partner has made any kind of drawing has reduced the capital. So any activity which reduce the capital should revert back. That should be added, and any kind of activity which has increased the capital, that should be deducted, so that we can get the exact amount. Now drawing made by partner, we have to add this amount. Interest on drawing. So if a partner has made drawing, interest has charged on him. If interest has charged on him, then it's a loss. Then it will deduct the amount. So if this interest on drawing is deducting the amount, then we have to add it back. Then share of loss already debited. If there is any kind of share of loss, if it isn't debited, then we have to add this amount. Now certain points that we have to deduct, that is partner salary or commission. See class, what's happening here? If we have provided salary or commission, what it has made, it has increased the capital value. So the value of capital has increased. So we have to deduct this amount so that we can get the exact value. Then profit, partner share of profit already credited. This one also has increased the capital. This must to be deducted. Then adjusted capital. If any kind of adjusted capital like point has been given, then we have to deduct this amount. What is adjusted capital? Where we have adjusted the capital. Okay. See class, understand this point clearly. This adjusted capital means cumulative gross proceeds generated from sales of the company's shares less distribution from non-liquidating disposition of the company's investment paid to stockholder is the adjusted capital. But for your level, you will directly get the amount stating adjusted capital. So if we do certain kind of addition and deduction, we will get the opening capital, and we have to provide interest on this amount only. So this one is the basic format. Now split up format. See class, in case of fixed capital, if the capital is fixed in the firm, then what we have to do? Then we will have the closing capital, then add withdrawal of capital less additional capital introduced. Then by doing this thing, we will get the opening capital. See clearly, we have the closing capital, we have to add the withdrawal of capital, that is the amount of capital withdrawn, drawing made, then additional capital introduced, then we will get the opening capital. This case was in case of fixed capital. Now if we have the fluctuating capital, then we have to find out the opening capital in this very way, that is closing capital. We have to add what? Drawing against capital, drawing against profit. We have to add interest on drawing. We have to add share of loss already debited. Then we have to deduct additional capital introduced during the year. Then we have to deduct partner salary or commission already credited. We have to deduct partner share of profit already credited, and interest on capital. If all this thing has been provided, then we will get the opening capital. Okay, see clearly, we have to add drawing against capital, drawing against profit, interest on drawing, share of loss, whatever the things that is deducting our capital, that should be added back. And what we have to less? We have to less that amount by which our capital is increasing. Okay, I think this one is clear. Now accounting treatment. So after getting the point, we have to do certain accounting treatment, and accounting treatment state that interest on capital account should be debited, that is interest on capital account debit to partners capital or current account. Interest on capital account debit to partners capital or current account. So at the end of the year, interest on capital is transferred. Listen carefully, at the end of the year, interest on capital is transferred to debit side of profit and loss appropriation account as profit and loss appropriation account debit to interest on capital. Because this interest on capital is an expense for the firm, so firm will write on the debit side, that is profit and loss appropriation account debit to interest on capital. And what will done here? Interest on capital account debit to partners current or capital account. And what will happen in the partners current or capital account? This interest on capital will be in the credit side, that is it will increase the amount of capital after providing interest. Now class, we have one more format, that is opening capital can be calculated as balancing figure by preparing capital account of each partner. That is, this is also one of the easy way, that is you have to create the partner's capital account. Okay, now see, in debit side, what we will write? Partners capital account debit to cash or bank. Why? We are doing drawing against capital. Partners capital account debit to drawing, that is drawing against profit. That will be also expenses for the partner. Interest on drawing is the expense of the partner. Profit and loss appropriation account, that is loss would be expense for the partner. Now balance CD will be provided. What is balance CD? That's the capital. Now capital introduced. What we will write here? Cash or bank account debit to partners capital account. So in partners capital account we will write by cash or bank. Then interest on capital account debit to partners capital account. So in partners capital account, what we will write? By interest on capital. Okay, partner is receiving salary or commission. What we will write? Salary, partner salary or commission account debit to partners capital account. But in partners capital account, what we will write? By partners salary or commission. Now share of profit. So by profit and loss appropriation account debit to partners capital account. What we will write in partners capital account? By profit and loss appropriation account, that is share of profit. Now you have to do the calculation, then you will get the balancing figure, and that balancing figure would be the balance BD, that would be the opening balance of the firm. Okay class, now we have certain provision relating to interest on capital. What happens? We somehow skip this point, but what I think, this point is not to be skipped. You have to study this point. What said here? That interest on capital is allowed if it is provided in partnership agreement, as we have stated earlier. It should be noted that interest on capital will be allowed out of profit only, not out of capital. Here three cases are provided. Okay, we have the three cases. What are the cases? First case, if partnership agreement is silent about interest on capital. Okay, if partnership agreement is completely silent about this point, then no interest on capital will be allowed. Case 2 is partnership agreement provide for interest on capital. Listen carefully. Partnership agreement or deed provide for interest on capital but is silent in treating interest as a charge or appropriation. But deed has not said that whether we have to charge or treat this interest as a charge or appropriation. In this case, interest on capital will be allowed only when there is profit. Okay, if there would be the profit, we will provide interest on capital. If you will have loss, then no IOC will be allowed. See, it's written there that we have the three possibilities. First, in case of loss, then we will not allow interest on capital. In this case, second case is in case of profit. Listen carefully. In case of profit, we have made the profit before interest, before providing interest is equal to or more than the amount of interest. That is, we have the excess profit. At that time, agreed amount of IOC will be allowed. Now, what would happen? What would happen in case of profit before interest is less than the amount of interest? That is, whatever the amount of interest we need to provide to the partner is greater than the profit. Then at that case, interest will be allowed up to the amount of profit. Whatever the amount of profit we have, interest will be provided up to that amount only. And the third and the last case is partnership agreement provide for treating interest as charge. Okay, partnership agreement or deed provides for treating interest as a charge. So in this case, full interest will be allowed whether there is a profit than the amount of interest or a loss. Deficit is treated as loss, and loss arising due to payment of interest on capital will be shared by partner in their PSR. See, what is happening here, that we are making a loss if we are paying the interest. So in this case, what is said, that if we are getting a loss, it doesn't matter, we have to share the loss if any arising in their profit sharing ratio. Then at that case, profit and loss account is prepared instead of profit and loss appropriation account. This one is the main point. Profit and loss account is prepared instead of profit and loss appropriation account, and interest on capital is treated as a charge, and whatever the interest we will ascertain, that would be treated as a charge. So class, this was all set for today. We have to solve some question regarding this, and after solving we will be able or proficient in calculating interest on capital in any type of question. Okay class, thank you very much. Thank you for your cooperation and support. Thank you.